So now let's learn the components of the quality management process which are prescribed by ISQ M1. The first one is the firm's risk assessment process. What is a firm's risk assessment process? As per ISQ M1 para 1, it explains that the risk assessment process undertaken by the firm for managing the quality, which is broadly similar to the way the risk is assessed and managed within any entity. Like in any entity, what are the process they follow? How do they identify whether the process they are following is of high quality? Let us say iPhone, Apple. Apple wants to ensure that the product they sell out is of high quality. So how are they, ensuring that every product they sell is of high quality? They do some testing. They first establish a process. They first identify where the risk of iPhone is. To give an example, if the iPhone drops, if it drops from our hand, is it breaking into pieces? Is there is damage to the glasses? So the glasses could be damaged. So what they will do? They will ensure that high quality glasses are being installed. When the phone is dropped, the back of the phone could damage, the camera could damage, or the touch could damage, the touch screen could damage, display could be damaged. So all of those should be of high quality. So those are the risk. So dropping of the phone is a risk there. So similarly, even when for an audit firm, when they are performing the audit, there are risks attached to the audit. Like they might not do it in a high quality way. They might miss to audit something. They might miss to ask an evidence. They might miss to conduct a procedure. They might miss to ask certain questions to the client. So how do they ensure that such things does not happen? Such risks are not faced by the auditor. So for that, you need to ensure that you are identifying the risk related to the quality as well. What if there is a new employee joins the firm? That's a risk for the auditor because the employee have to be trained. So any employee, before they are given to a engagement team, they undergo a rigorous training. The moment they undergo rigorous training, their knowledge and their quality will improve. Secondly, when a new employee joins the firm, they are monitored for 6 months. Like whatever the work they do, they are deeply reviewed by the senior. So what happens? Any mistakes that's identified by the done by the junior can be identified by the senior and advised to ensure those mistakes are not committed. So those are the risk assessment process that are established by the firm. So firstly, they need to identify for any risk, for identification of the risk, you need to have quality objectives established. So the firm, firstly, what they're going to do is to establish quality objectives. They will establish quality. You need to establish quality objectives. Now, what are the quality objectives? When the Apple CEO says that my phones should be of highest quality, it should not break when they drop, that's an objective. So similarly, for any firm who are conducting the audits, they will say that the mistakes identified in the audit should be very less. It has to be reviewed. The audit juniors, how much mistakes they do have to be less. Those are the quality objectives that the firm may establish. But ISQM says that any audit which they conduct, and an auditor should have a quality objectives. And what are the quality objectives? The components that we learned. They should have proper documentation into the components of the quality management. What are the components? Risk assessment, resources, engagement performance. They should have all the processes and policies established where they are fulfilling all the components in relation to the quality management. That will be the first case of a quality objectives. But at the same time, the quality objectives adopted by the firm shall not just include for ISQ M1, but could also be additional objectives that the auditor can establish as part of their own quality management process. Once they identify the quality objectives, what are their quality objectives? The second one is to identify the risk that might jeopardize the firm achieving the objectives. So the risk have to be identified and assessed. Like if a risk is identified and assessed, what could be the impact? If the risk is, is identified, what could be the impact to the quality? And for all the necessary risks which are assessed, necessary responses have to be designed and implemented. Necessary responses are required to be designed and implemented. which will lead to certain policies and procedures that make up the system of quality management. So you first identify the objectives, you then identify what are the risks that could affect the objectives, and then create necessary responses how you will tackle the risk so that the risk will not go further and attack on the objectives of the firm. That is the process of the risk assessment. A simple process that the firm does. When they are identifying the quality risk that could affect the firm's objectives, it could be in relation to the nature and circumstances of the firm, like the complexity of a particular audit. To give an example, let's take an example of Byju's. The company who took next the Byju's, right? The audit firm which took the audit of Byju's next after Deloitte resigned will have high quality issues with them, for them, because the complexity of that audit is so heavy. Their previous auditor resigned, the financial statements are delayed, lot of things, so they will be pressured. The auditors themselves will be pressured. They'll have to continuously discuss with the management to ensure that the quality of the audits are of high category. So it's going to go through a rigorous process. So there is a complexity could affect the quality of an audit. Leadership style. If there is a leader who is so much pressing, who's so much pressurizing, asking us to give us the finish of the audit work in timely basis and to finish it off on early basis, definitely the quality could be compromised. The seniors and managers will have to give to the partner without doing the things properly. What are the resources which are under their belt and ownership? Do we have enough resources? That also showcases for the quality. The next one is the nature and circumstances of the engagement performed by the firm. Like generally if a firm is performing audits of only a specific type of industry, let's say for example they are performing only a manufacturing industry. Now suddenly they want to audit financial services industry. It's going to be difficult for them because they have never audited a financial services industry before. So the partners of the firm do not have enough expertise in terms of the financial services. So definitely their audit which they are doing, which in relation to the financial services audit, could be affected because the nature and circumstances of the engagements are similarly done by the auditor is of the some other industry and not the industry that they are going to pitch in now. So those could affect the auditor. In certain other cases, which might not be immediate, the quality risk may still affect the quality objectives. For example, the business strategy where its financial goals are driven by providing services to the clients that are not within the scope of the audit quality management standard. So they are providing certain services so that they can earn some money. This might mean that the firm's resources are prioritized for services leading to a negative impact of the quality engagement that are included under the ISQM1. So the firm wants to ensure that they provide the services at a low cost. So if they are providing the services at a low cost, they want to ensure that they want to get more business from the clients. But when you are doing something on a low cost, it will be difficult for you to bring in some additional resources and complete the work. Definitely the audit quality will be compromised there. So that will lead to a negative impact on the quality engagements that are included in ISQM 1. Right? So as I told you, maybe the firm is a new firm and they want to establish their presence, so they might reduce the quality, reduce the cost. When you're reducing the cost and you get a client, you might suffer because you cannot hire someone else, because if you hire someone else, your cost will increase and you will be at losses. So the business strategy of how the audits are being managed could also lead to the quality management. The process of risk assessment needs to be thorough enough to consider all appropriate risk. One example is scalability. Risk assessment will vary depending upon the structure and organization of the firm. So as the firm grows, do you really think that the risk will reduce or increase? It will increase. When a firm grows, when they have more revenues, when they have more clients that they are dealing with, their risk of quality will increase because they will have less resources, more clients. They will have less technological skills because they are not ready, but they have 100 clients to cater to. the quality could be compromised. And systems and processes, more the firm, the bigger the firm is, heavier the systems will be, heavier the structure of the organizations will be, which will lead to lack of cooperation among the employees, which could lead to quality constraints. So in order to tackle all such issues, auditors should have responses created or developed to tackle each of the risk. They need to have suitable policies and procedures which are implemented, etc. We will learn that in detail, but certain specific responses that might require are like, for example, identifying and addressing both threats to breach of relevant ethical requirements. What if we have given a proposal to a client, and the client came back and accepted it, but we identified that we have independence issues with the client as part of the ethical requirement. Now, if you have independence issues, you should not accept the client. But looking at the fees as a prominent revenue, if the auditor accepts it, then they are ignoring the quality of the audit, because independence could lead to threats to objectivity could lead to auditor's judgment being compromised. So that's an example. So as a response, we need to have strict policies and procedures implemented in relation to the breach of ethical requirements. Like if the auditor, the partner, is not reviewing the independence, or he is accepting a client which have independence issues, the partner have to be penalized. If any company is any employee of the firm is accepting bribes without the consent, without even knowing, without the partner's knowledge or something like that, then definitely it has to be considered in a severe manner and have to be penalized for their breach. Confirmation, and you can also take confirmation that the firm is complying with the independence requirements, not just the firm but the team and the partners, and at an employee level all are compliance to the independence requirements. Resolution of any complaints or allegations with no-CLAR related items or firm's policies and procedures. Like they need to incorporate certain policies and procedures on how do they go about certain complaints relating to no-CLARs. What if we get a complaint that the company is having a no-CLAR issue? What do you do? What are the policies and procedures you do? Managing information about the relationship with the clients, confidentiality. Right, confidentiality. Now, do you breach it because you have a legal case? Now, is the client doing some money laundering? Then you definitely have to breach it. Because if the client is doing criminal activity, there's no way that confidentiality can be maintained. Communication protocols with external parties. Communication protocols with external parties. Like, how do you communicate? How the employees communicate? You need to communicate in a more professional manner to ensure that those charged with governance and the management are not satisfied with the way you're communicating. So we need to ensure that the communication is very key in this case. And when you're communicating with the external parties, you're communicating in such a way that you as an auditor, will have a confidence in you. Identification of those engagements that require engagement quality review. So when you do a KYC, definitely if the company is of a public limited company or a public interest company, or the company is huge, you will identify that it requires an engagement quality review, which means there have to be additional partner, not just one partner who signs off on the engagement, but additional partner who will review the work of the engagement partner and signs off on the quality matters, whether the audit process and procedures or judgments, significant judgments are conducted the way they are supposed to be conducted, etc. Relating to the engagement quality review, we will learn it when we are going to look at a component called as engagement performance. So to go through this, there is a flow chart which will help you to understand. Firstly, we identify the quality objectives for any firm. The second, what we are going to do is identification of quality risk. Based on the quality objectives or based on any engagement, we identify the risk that could affect the quality of the audit. The second question we ask ourselves is there a reasonable possibility of the risk occurring? Is there a possibility that the risk could occur in this audit? If it is no, then no action required. We don't have to do anything. Like, it's fine. No response is required because there's no reasonable possibility of a risk occurring. If it's yes, there is a chance of a risk occurring. Would the quality risk individually have a significant effect on the achievement of a quality objective? If it's yes, then what do you do? If it's yes, then you identify the quality risk and create responses how the risk have to be addressed. If it's no, you ask another question. Would the quality risk in combination with other quality risk have significant effect on achieving the quality of the objectives? So you identified a risk, but the risk in isolation or individually does not affect the quality objective. But do they in combination with another risk? So two risks together can combine together and have an effect on the achievement of a quality objective. If it is that is yes, then you have to identify the risk and necessary responses have to be created. But there is a risk, but the risk does not affect the quality objective. Neither the risk in combination with another risk does not affect the quality objective. Then the answer is no. So you don't need to do any further action. You can stop there. So first and foremost, we identify the quality objectives and then identify the risk that could affect the quality objectives. This is the second process. So that's the first component, risk assessment process. The next one is called as governance and leadership. As I told you, in any firm, the quality starts from the top. The top management of the firm, the top partners, the top executives of the firm should embark their quality journey and have strict culture, code, conduct, rules, regulations and review process which will be carried down to the junior partners or managers and the as well as the junior auditors, etc. So throughout the firm, if you want to ensure the quality objectives are maintained, the tone have to be set at the top. So the quality objectives with respect to the governance and leadership establish the environment that supports the quality management. To give an example, demonstrating a commitment to quality, leadership and responsibility and accountability for quality, setting an organizational structure, assignments of roles and responsibilities, an authority that will help to enable the design, implementation and operation of the firm's quality management, resources which are planned for and resources which are obtained, allocated in a manner that is consistent to the firm's commitment to quality, etc. So, the firm's quality management is also achieved through responsibilities that are established for the quality management by the senior staff members. By number one, taking ultimate responsibility and accountability. Like the partners, managing partners, chief executive officer of the firm, board of partner, whoever is responsible takes the ultimate responsibility of establishing quality management for the processes. Operational responsibilities which are assigned to separate personnel, including specific aspects that include compliance with independence and remediation and monitoring. So operational aspects include at an engagement level who takes the responsibility of ensuring that the quality are operating in an effective manner. It is expected that all roles are assigned to individuals who possess appropriate levels of experience, knowledge, and that they understand their role and are accountable for fulfilling the quality. So as an governance and leadership, it is very important that everybody have a leadership quality within themselves. Like they take responsibility for the work that they are doing and doing the work with utmost quality. So it's not just at the tone at the top. The tone at the top, it should start from there. Like they should enforce commitment to quality and ethics at a firm-wide level. But ultimately, there could be 1% or one black sheep which could spoil the entire lot or the entire firm. So to avoid that, everyone within the firm need to go through rigorous trainings which are required by the governance leadership who enforces on these members. They create the quality governance and leadership, or the senior partners create rewards for fulfilling the quality of the audit very well. They create even penalize penalties for not following the qualities. And the partner should not focus on revenue losses from the client, but rather challenge the client's judgment without fear of negative consequences. That actually shows the commitment. So if there is a partner who challenges this, and if the senior partner comes and says, you know what, you're losing me revenue, then the partner will never challenge a judgment. Similarly, every employee should be given the freedom and authority to question the client, and unnecessarily no need to take any pressures in respect of the audit process they are following. And they should have enough strength and as well as they should have enough guidance given to them that they own the responsibility and accountability for the quality, as well as they do not delve into undue pressures that are given by the client. This is the tone and the culture that emits throughout the firm. If every single staff and every single employees are given a sense of responsibility and authority, the quality of the entire work that is done by each and every employee will be of higher category. And the next one is relevant ethical requirements. So the firm should establish quality objectives which are designed to provide it with reasonable assurance that the firms and the personnel both understand and fulfill their responsibilities in relation to the ethical requirements. So what are ethical requirements? The 5 fundamental principles that we learned, right? Which is integrity, objectivity, confidentiality, professional competence and due care, and professional behavior. And in objectivity or in integrity, we learned about the threats to independence. Now, these threats to independence, one of the simplest examples is accepting of gifts and hospitality. So, let's say a client is there and client is, treating us every day with 5-star hotel, buying us good quality food, giving us gifts during certain occasions. It will be considered as bribes. So, there has to be proper standards that are established or policies that are established by the firm, which will enable their employees to reject certain kind of hospitality treatment and identify the threats that they could face as well. So the firm's quality objectives should emphasize on the fundamental principles which have been established by ACCA, and the standard also explains that may be possible for the firm's system of quality management to go beyond the provisions of the relevant ethical guidance. For example, accepting all gifts, no matter what their value or significance, is prohibited. So they are not just, going ahead and telling that, okay, you know what, because in ISBA's code of conduct, it says that if it is insignificant value, you can accept it. But as a firm, in their objectives, they can establish a tone that any kind of gifts and hospitality cannot be accepted. And if you're accepting it, then you have to face the consequences. Rotation requirements, like even though we say that, okay, you know what, in the threats to independence, for familiarity, you are rotating the partner after 7 years. Now there could be cases where within the firm, they could, to enhance the quality, they will say after 5 years we'll rotate the partner, or senior managers after 5 years will rotate the partner. So they might extend not just to the partner but to the team as well. So if team has audited the firm, audited a client for 5 years, we will rotate the partner, rotate the team members. That could be considered as fulfilling the ethical requirements. So now what you need to understand is that for an audit perspective, AAA perspective, subject perspective, for your exams, there will be situations where in a scenario they are not in compliant with the ethical requirements. There could be cases where auditor accepted a bribe or gift or a hospitality. They did not rotate the client for 10 years. So as a candidate, you are required to apprise these ethical constraints and how does it impact the quality management. You also have to explain in relation to the breach of code of conduct, or you have to explain how they are affecting the threats to independence as well. So when you have certain ethical issues that you're identifying as a candidate, you just don't have to write it from the independence issues, but also you have to talk from the quality management perspective as well. But in AA, we just used to mention what are the ethical threats that we are facing there. But in AAA, you have to go beyond one step and mention that it affects the quality management and quality objectives of the firm as well. And proper safeguards have to be established. The candidate, for you to obtain additional professional marks and technical marks, you have to explain the significance of that ethical threat and apply the safeguards as well. And talk about the quality management as well. Only if you write these three things, you will obtain the professional marks. Because if you're just identifying the threat and just mentioning that this is the threat and this is the kind of threat that will affect, but if you write about that it links to the quality management as well, additional professional marks also you can score. So whenever you're reading a scenario, think whether there are any ethical constraints or ethical threats. If yes, talk about the threat, the safeguard, and also the quality management as well. The next one is called as acceptance and continuance of the client relationships and specific engagements. So for any firm to ensure that their audits are being conducted with high quality, it all depends upon what kind of client they are onboarding. So if the client themselves are of, complexity in nature, or they have issues or they have problems, then it could affect the quality objectives of the firm as well. I'm not telling that, any client they onboard might have a problem, but a client they might onboard might not just have a problem where they might have integrity issues, etc. That's a secondary part. But a client they might onboard might have certain risk, which we will study in chapter 6. Now that risk could affect ultimately our quality as well. What if we as auditors do not know how to manage the risk established in an audit? Or what if we don't identify the risk? What if I don't have an expertise auditing a client within that industry? Do I take up the audit again or should I leave them? So those kind of things we need to consider before accepting a client. So even before we onboard a client, or when we are in the process of onboarding a client, we need to understand in detail about the entity. We need to get or gather sufficient information obtained about the entity, the nature of the entity, the circumstances of the engagement, even the integrity and ethical values of the client, the management, about who the management are, whom do they support, what are their major revenue model, is there any money laundering issues, what kind of entity are we auditing, is it a public limited, private limited, partnership? Because all of this nature and circumstances of the client will affect the risk in relation to the audit. The second thing that could affect is the firm's ability to perform the engagement with professional standards and applicable legal and requirements. The firm might not have enough resources or might have other priorities due to which they cannot take up additional client. If that's the case, the firm should have the strength to reject a client because they do not have enough resources, or they are prioritized, or their hands are full. But even just because they want to have additional source of revenue, if they accept the client, they will be under undue pressure to finish the audit of the client, and because of which there could be lack of quality, because they might not have time. Everybody is busy, the partner is too held up, so he might have to finish the work as early as possible, and that could lead to quality management issues. So before you accept any client, proper due diligence, proper KYC have to be maintained, proper information have to be obtained with respect to the client. But at the same time, if you are having an existing relationship, the firm is already providing relationship or already providing audits to existing clients, then at the start of each year, auditor should do re-KYC checks. He should repeat the independence declaration of the employees. He should re-evaluate whether there is conflict of interest or any competence to perform the audit, etc. So the acceptance and continuance of the client talks about two aspects. One is, before you accept, what are the things that you need to do? What are the things that you need to obtain? So as I told you, information about the ethical constraints of the client, information relating to the nature of the engagement, whether you are capable to provide the audits with applicable laws and regulations, And don't accept the client just because of financial or operational priorities, like you want to have additional revenue or you want to add more clients. Just because of that, don't take up the audit. But at the same time, not just this, but for an existing client as well, every start of the year, every year we do fresh KYC checks. We repeat the independence process. Like every year, any team is being added, any team member is being added or removed, or even any existing team members who are going to conduct a new audit. Every year an audit is conducted as a fresh audit. And every year the employees who are supporting the client, their independence declarations have to be obtained. Their independence have to be checked. Their relationship have to be checked. The conflict of interest have to be re-evaluated. Why? Because it's a new year and it's a new audit for the existing client. And if it's a new year, definitely there could be cases where you would have onboarded a competitor of the client, which could lead to conflict of interest. There could be cases where a partner left the firm. The auditor, the person who was auditing, the partner who was auditing this client, he left the firm. So now a new partner is coming in. So it will question his competence. So new information or additional information we have achieved, which could lead to us looking at aspects where the relationship still we are able to commit it, and will we be able to provide the audits with utmost quality or not. That should be assessed.